Good evening, good morning, good afternoon. We are pleased to welcome you to this webinar, whose topic is Innovative Approaches to Commercializing Digital Payments. It's being brought to you in partnership between Mondato and MEF. And this session includes stakeholders from various parts of the fintech ecosystem, and we are showcasing innovative digital financial products from digital and neobanks to B2B e-commerce and alternative methodologies for data scoring. And what we're seeking to do is to share various perspectives on how the participants in this webinar emerge and perceive emerging opportunities and challenges for commercializing these types of services and other types of services as well, both in general as part of the general trajectory which we are witnessing within the financial space. And of course, we can't avoid the elephant in the room, COVID-19, which has certainly worked to catalyze and expedite a lot of the changes that have been underway over the past several years. And we're going to talk about how technology and really collaboration within institutions and across institutions are key in developing and deploying successful offerings. Joining us today are distinguished speakers, thought leaders from across the digital payments and the wider digital finance space. We are joined by Camille O'Sullivan, who is the Vice President of Corporate Development for Lendo EFL. We are also joined by Mahesh Narayan, who is the Global Product Lead for Mobile Money and E-commerce at Standard Chartered Bank. And each of them will provide us with an introduction to their institution and the type of work that they are focused on and some initial thoughts on this very broad and complex topic. And before I turn the floor over to them, I'll briefly introduce myself. My name is Judah Levine. I'm the CEO of Mondato, which is a boutique advisory firm focused on digital finance and commerce and fintech. And much of our work is across emerging markets, as well as developed markets in what is becoming and really has become a very dynamic space over the past several years. And in fact, one of the early questions to preview our participants that I'm going to focus on is that dynamism and all of the rush of activity that we've witnessed over the past several years, but in particular over the past several months in redefining the confines of the space. So I'm very excited about the discussion we're going to have today. I invite the viewers to participate and to register their questions as we go along. And with no further ado, I'm pleased to welcome Camille, who will give us some initial remarks and observations from Lendo EFL. Please, Camille.
As you know, I'll be presenting a few slides. So my name is Camille O'Sullivan. I'm the VP Corporate Development for Lendo EFL. And Lendo EFL is basically a fintech which has for mission to link good borrowers without traditional data to lenders. And so we do this by using alternative data that is already available on most people nowadays, such as your phone information, or we create data such as a psychometric test. And this data has proven to be predictive of risk over and over again. It's interesting because all it takes for us to get an actionable credit score on anyone nowadays is for people to, a credit bureau will need someone to have been dispersed already. And so we basically are able to remove a significant hurdle towards financial inclusion. So as you can see here, most lenders focus on traditional data. So what traditional data focuses on is mainly the individual's ability to repay. what we mean, we believe that kind of this traditional data is therefore a bit limited, right? So you're only seeing one aspect of the customer instead of seeing their full picture. And so that's where alternative data comes in. So basically, alternative data enables us to focus on the customer's willingness to repay, in addition to the ability to repay. And that's, you ideally need both segments when you analyze a customer's risk profile. And so obviously, alternative data can be used by itself. So when there's no traditional data, it can be a proxy for traditional data, but it can also be used in addition to traditional data because of what I mentioned, this kind of focus on willingness to repay instead of the ability to repay. So when we say alternative data, we mean things like a psychometric test, some device data like your Android or your iOS phone data. So things like that. So how does it work? So basically, LenderEFL collects data that is already available, such as phone data via our SDK, or we create data. So we can create a psychometric test. So we basically collect, we ask customers to fill out like a psychometric test at the point of application. So all this happens when the customer applies for a loan. And then basically receive over 10,000 data points on all these customers. And then from there, the data goes through our algorithms and our models. And like the bank receives a 3-digit credit score that they can use to make a decision whether to lend money or not. So if we go to the next slide, so how do we use LenderEFL's alternative credit score? So I think that is obviously the key question for a lot of people out there. And so I think there's kind of 3 use cases, 3 bank types or lender types out there. And so the first kind of use case is, I'm a lender, but I don't have, credit bureau information on my customers, either because the country doesn't have a good bureau, or my customers are a segment that have available traditional data. So in that case, we think that you should use alternative data as a proxy to credit bureau. So what we've seen is, and this is, over like multiple models that we've built all over the world, that we get to AUCs of around 70. So an AUC is an area under curve. It's a metric of like how predictive a model is. And so that kind of AUC is very much on par with the AUC's bureau score. Obviously, for that first use case, we would not be able to compare it to a bureau score because that use case assumes no credit bureau score. But as you'll see in the next use cases, this is very much usable to lend to customers, even if they don't have this traditional data that people rely on nowadays. The second use case is for people that have, quite a lot of customers that have credit bureau information, but some customers don't, and they end up rejecting them. And not because it's an actual decision, they're just rejecting them because they're thin file, so they don't have much information. And these customers often end up going to competitors. It's a shame to obviously reject them just because they don't have enough information. And that's why we believe, again, that you could use an alternative credit scoring company such as LenderEFL to reassess your soft rejected customers. So here, at the bottom in that table, basically it's an example of how we've seen our traditional scores compared to LenderEFL scores perform. And what we've seen is that for these kind of customers, so for the soft rejected customers, our score outperforms the credit bureau. So our AUC in that case was 68, the credit bureau score was 60. And so, we can really add a lot more value for thin files. And again, I think a very decent, achievement in terms of AUC performance. And then the last use case would be, for customers, for lenders that have, mainly all their customers have a credit bureau score, and so can they use alternative credit scoring? Well, we believe that yes. So the reason for that is that what we've seen is that our score is completely uncorrelated to a credit bureau score, and therefore we can lift the predictive power of a traditional credit score quite a bit. And so again, going back to that example from this bank in Asia, we've seen that while the bureau score outperforms our AUC slightly, again, I think they are quite on par, but they're still a bit different. What we've seen, however, what's interesting is the correlation percentage. So there's only a 12% correlation between the bads that we find and the bads the bureau finds. So we're finding completely different good and bad customers to the bureau, and that's why we can add a lot of value on top of the bureau score. And I think that's an interesting use case for a lot of banks out there. So how does partnering with SaaS work? So basically, the idea is we will have to integrate. We've got easy to integrate SDKs and APIs where basically, which enables us to collect the alternative data on the customers. And then from there, we assume that it will take about 30 days for the integration to be completed. And from there, from day one of you going live, you'll be able to get insights on your customers. So what that means, these are key character traits that we know to be predictive of risk, and you can use these to drive your decisions. We can also send you back an out-of-the-box kind of model, credit score. And so you can use that. And then obviously, the whole point of this partnership is the more data you collect, the more data you learn from. So, once we start collecting more data, more repayment data, we can then build a custom score, which is obviously the ultimate goal, and that's where we get this kind of AUCs that we just shared before, and the very high predictive power that we expect from our scores. And so that's kind of how the partnership with Lendo EFL would work. You basically need to see this a bit like an investment that kind of grows the more data we get, and becomes more valuable the more data we get. And then our last slide just shows some of our experience. So some of our customers around the world, as well as some of our awards that Lendo EFL has won. Thank you.
Camille, thank you very much. That is very interesting, and I've taken notes down on my pad here feverishly. So I'm looking forward to the question portion of our discussion. Mahesh, we were very keen to hear a little bit more from your side. If you could offer some introductory comments, please.
Sure. Great to be talking to all of you. I'm Mahesh Narayan, based out of Singapore. I work for Standard Chartered Bank, which is an international banking group headquartered in UK with a global presence in over 70 markets. Our core footprint markets being Asia, Africa, and the Middle East. So we are primarily an emerging markets bank. I'm the global product lead for our mobile money and e-commerce solutions as part of the transaction banking vertical. What we have witnessed over the last few years is this exponential growth in e-commerce, m-commerce globally. While this has been happening at a rapid pace, over the last few months with the onset of this pandemic, this has just gone through the roof. And what's also interesting to note is while these developments are happening at quite a rapid pace on one hand, on the other hand, there are a few interesting trends that are taking shape in emerging markets. Just to name a few, the exponential growth of payment methods, right? There are just so many different payment methods that are entering the markets today. as a consumer, it's a great time because there's just so many different ways in which you can pay merchants, right? The other interesting trend that we are also witnessing is the rise of instant payments combined with QR codes. Right? Central banks and governments across the globe are promoting these new age instruments in the hope of driving digitization in some of these cash rich economies. Now, what does all of this mean for businesses and organizations? Right? With the onset of the pandemic, what we have seen is most organizations across the globe, whether they are multinationals or large domestic corporates, mid-sized corporates, etc., have all consistently focused on driving digitization across their organization, right? Organizations have been in different phases. Some have been, of course, ahead of the curve. A few others have been, working on their blueprint to move into the whole e-commerce, m-commerce space. But what this pandemic has done is really, set a race among these businesses to move their businesses and operations online. And it's something that's become very existential for many corporations. Now, while that's a great story to talk about in terms of the sheer efficiencies that it's driving across these businesses, what's challenging for many of these corporations, especially the ones who are expanding their footprint across multiple markets, is the sheer fragmented nature of these ecosystems, right? So if you take the example of a multinational, that whether it is a B2C organization or a B2B organization, as they are entering this space, whether it is in the form of setting up a direct to consumer model in the form of an online portal or a mobile app or a specialized marketplace, right? uh, for the B2B interactions, a consistent theme that plagues many of these corporations is the ability to bring all these different payment options onto their platform for their end consumers to interact in a seamless manner when it comes to purchasing these goods and services. And that's where many of these organizations are facing a huge challenge, especially in emerging markets, because there's no one solution or one provider that can meet their requirements. As I mentioned, the markets are extremely fragmented. Uh, when you look at the West, right, especially when you're setting up an online portal, if you have credit cards, you are pretty much sorted, right? Because bulk of these payments would go through cards. But the moment you step into emerging markets, the sheer number of payment methods that are present and growing every day makes it quite a challenging proposition for these organizations, right? And what that means is these organizations, especially many of these multinationals, need to work with multiple payment service providers to bring all these payment methods onto a single platform and present an integrated solution to their end consumers, whether they are individuals or businesses. So what we are doing as a bank is simplifying that experience for these organizations, whether they are a B2C organization or a B2B organization, as they embrace digitization in the form of e-commerce or m-commerce. And how are we doing that? We are doing that on the back of partnerships with some of the leading payment service providers in our footprint markets, and by way of our direct participation in some of these instant payment or fast payment schemes that we are a member of today as a bank. And through that, what we bring to our clients, these corporates, is an omni-channel digital collection solution whereby our clients can connect to us through a single API and get access to multiple payment methods on a single platform that can be presented in a harmonized manner to their end consumers. So it doesn't matter whether you are a corporation doing business in Singapore, Hong Kong, Vietnam, Kenya, UAE, you get a one-stop solution working with us as their bank, such that they present a single integrated front end to their end consumers. And behind the scenes, we simplify the whole experience for these corporations in the form of a single integration, a single interface with the bank, and a single counterparty that they deal with without having to worry about negotiating multiple contracts, multiple integrations, multiple counterparties that they have to work with. And that's the value we are bringing to our clients, to these organizations, as they expand into these markets. So it's been a great story. We've had some good successes in this space, working with organizations. And again, the beauty of our solution is it is agnostic to the digital sophistication of the corporate. We realize that not all organizations are in the same boat. There are some companies which are ahead of the curve, that there are a few others who are still lagging behind and are catching up. So when it comes to our solution, what we call as straight to bank pay, it doesn't matter which part of the curve you are in, whether you are a sophisticated multinational who's got an online portal and you're now trying to plug in the alternate payment methods, or you are a corporate who's still quite brick and mortar and just getting started on the journey. This is a solution that can cater to all these corporations. And then again, being an omni-channel solution, it cuts across different sales channels of these organizations. So whether it's an organization trying to digitize their collections through an online store or a mobile app, or trying to digitize their face-to-face collections, whether it is in an in-store setup or the last mile collections, or through the invoices that they're sending to their consumers and distributors, this could be a single harmonized solution that can help them achieve that standardization in terms of how they integrate these different payment options onto these channels, and then find that single visibility in terms of the inflows, whether it is in terms of the information around the transaction, uh, the reporting, reconciliation, etc. So that's where we are in this journey. Uh, we are expanding the solution across our entire footprint, and as we speak, we are actively working with our clients to help them in this journey and simplify their entry into e-commerce and m-commerce.
Thank you, Mahesh. Fascinating, really fascinating. And what I also love about sort of these two sets of introductory remarks is they're very much complementary. On the one hand, we have sort of one discussion oriented around how do we enable more consumers and other purchasers, businesses, perhaps small businesses, be able to become credit worthy, or even if it's not even becoming credit worthy, it's discovering their credit worthiness when otherwise it may not be obvious through traditional systems, right? And on the other hand, we have sort of the complementary, how do we enable those who are able to transact and have payment to be able to engage with those who are selling in a more sort of simplified manner. And where I'd like to start the questions, perhaps Mahesh, since your remarks were last, I'll start with you. You know, when we both in the course of our work and publications, when we review sort of what's happening in the marketplace, and you might consider us insiders because we're on the pulse constantly and reviewing what's occurring. We ourselves even find it confusing and chaotic. I mean, there are so many announcements that are coming out daily from so many different types of players that one gets the sense that the only constant here in this space that we all occupy and enjoy is the change, and the change is incredibly fast. And in the space that you're describing of payments, it's it's incredibly topical in terms of the different launches and offerings that are being put forward by different organizations, and even in terms of a lot of the M&A activity and a lot of the partnerships that are being put into place. And you noted in your comments that in Western markets, the credit card schemes are fairly common, so it's much simpler to integrate from a point of sale perspective, whether it's a traditional one or an online one or an M1. But then a lot of what we see here in terms of the fragmentation is in emerging markets. And I guess where I'd like to start the questions is this situation, and if we want to keep it sort of as a two-dimensional question, we have the governments that are trying to promote more digitization on the one hand and the cash-rich economies. And on the other hand, we also have many different types of private sector players that are coming about with various payment schemes and solutions to address the opportunity. Is this a temporary situation? In other words, are you trying to sort of help us all engage with really what is something that's going to look very different in 5 years, because we're just going to see out of all of this chaos some more scaled market share rich entities emerge, and so there'll be some more constants and lesser options? Or do you think that this fragmentation is just the new world we're going to live in, and you're going to have just dozens if not hundreds of different types of national schemes and different types of payment alternatives, and this is the brave new world we're going to be in?
Sure. That's an interesting question, Julia. The way I see this is a lot of this fragmentation is also thanks to technology that's all pervasive, right? Whether you look at the rapid penetration of smartphones, right? Or as I mentioned earlier, the popularity of QR codes, etc., right? And that's what I would say is to a great extent fueling these transformations and the fragmentation. So and also coupled with the fact that the business models fundamentally are evolving, right? A few years ago, and not so far, as long as you are a multinational, say, with a fantastic brick and mortar setup and great customer experience, that's all you had to focus on. But fast forward to today, it's become quite an existential situation where every organization, no matter of their size and scale, have to embrace the so-called omni-channel experience, right? And as they do that, what we are witnessing is, this, growth of, payment options, is how it typically starts, right? In many markets, because, once there has been a success story, there are many others who quickly want to jump onto the bandwagon, right? As an example, when mobile money, first became a success in Kenya with the M-Pesa story, within no time you saw mobile money ecosystem mushrooming across the continent, whether it was sub-Saharan Africa, and soon the winds of change caught up in Asia as well, right? So mobile wallets became quite a rage. And while that was happening, you saw this shift towards fast payments, instant payments, and thanks to push by central banks, those started taking shape. right? And then once those fast payment schemes became popular in one market or two markets, soon the central banks would look at each other and see how could they then embrace those developments in their market. So I think, as they say, success breeds success. So I think players are also learning from each other and trying to replicate a lot of Me Too solutions, and that's what is in a way giving rise to this fragmentation, right? So that's how it starts in most markets, but over time, what I see happening is, especially in markets where the central banks or the government step in, they are trying to introduce common standards, bring in interoperability to promote, financial inclusion. Right? That's key. Right? As much as it's important for businesses to succeed, it's also important for these instruments to see mass adoption, for them to really move the needle in these economies. If you want to see, uh, you know, cash, the levels of cash go down, right? It's not going to disappear overnight, but at least reduce levels of cash, and that's the trend, right? There are you see any market, there are proliferation of QR codes that enter, whether it's one or multiple providers, and then overnight we are seeing governments introduce national QR standards where they want all players to conform to a single QR syntax, right? And we are seeing this trend catch up in many markets. So the way I see this, the growth and fragmentation of payment methods will continue to happen, but over time, as central banks and industry bodies jump in to bring that harmonization and interoperability, uh, you will see players uh, trying to conform to that standard, or even potentially consolidations, right? Because at the end of the day, you need to solve a true problem, right? You can't have so many Me Too solutions coexist, right? So that's how I see things developing in the years to come.
Okay, so my takeaway from that analysis is that perhaps we're getting fairly close to a peaking in terms of the different types of schemes and the different types of options, at least in some markets, that are being proliferated. And if we think of it a little bit as a diamond shape, it's going to start sort of trending in the other direction in due course, as there's a little bit more consolidation and harmonization. And that's really a good segue to the question for Camille. I mean, when we look at organizations trying to sort of traverse that digital journey and try and scale and look at it from the standpoint of being able to access and commercialize, bigger swaths of marketplace, how does how does the ability to access reliable credit scores come into play? And related to that, I found it fascinating that the alternative credit scoring is not correlated with traditional credit scoring to a great extent. So in a sense, they're complementary. How do you see that playing out? I mean, at what point does alternative become sort of more mainstream, and lose the alternative tag? Or do we sort of move towards this direction where we get a harmonization as more alternative credit scoring is coming about? The traditional credit scores will cover more and more market, and their alternative keeps shifting in definition, and some of the alternative becomes sort of part of the, let's say, standard accepted and common approach.
Yeah, no, I think you're right. Maybe alternative won't be alternative for so long, and it is shifting. But it's still such a big problem. Right? There's still so many people that do not have credit bureau information, that do not have, and it's a chicken and egg situation currently, right? I mean, it's really, you need to have received a loan to be able to get a credit score. And so, it's for sure, I think credit bureaus are considering a lot more data points nowadays, right? They're considering, even utility payments, telco. They see telco doing really well with telco data, and they see that, telco is selling their scores themselves. So there's definitely a catching up that's happening with traditional credit bureaus. But it's I think still today there's definitely a difference, and maybe there will be a play where we kind of all kind of work together more closely, but it is so far there's still a lot for this psychometric, which is really interesting data points. It's really the only kind of universal form of credit scoring you can do, because everyone can answer a test, and so that works for people that are literate, and anyone really. And so that's still, I think, we're one of the only, there's maybe one or two other companies doing it, but that's still very, very new, because obviously it maybe adds a bit to the customer journey. But so there's still, while everyone wants to resolve the financial inclusion problem, it's still quite a traditional kind of area. And so I think, it's coming its way, but it's still that there'll be alternative grades going for a bit to come, I think.
Right. So there's going to be, so you almost see it as parallel universes in a sense, and the alternative keeps sort of growing and evolving, while the traditional perhaps tries to address more of the areas that are getting qualified as credit worthy.
Yeah, exactly. So I think, a lot of people are going to, more and more people want to get into the credit system. And, in a way, once they've had their first loan, so we enable that, right? We really enable the first loan. And so, then they are in the credit bureau, if you see what I mean. So, we are complementary in that way. Obviously, there's some instances where, we still add, even on repeat borrowers, because we can do actually a lot of analysis of the behavior on the phone, or changes in the character. So that's why it goes back to this idea that, what we're measuring is a bit different to the credit bureau are measuring. But so it's also complementary even throughout the journey. But I think a lot of people see us more as kind of this first time credit score, like enabling these, like kind of reducing the market inefficiencies that are really inherent to how a credit bureau score customers. As we reduce that, we reduce the time, because all we need to give a credit score is someone to apply. So that's quite different to a credit bureau. But then obviously, and I think that's maybe something that people are not as aware of, is even when you do have a credit score, it is focused on a specific side of your kind of personality. And I think a lot of people have maybe not have thought like things like psychometric or things like character traits were not as objective, maybe assume they were more subjective, more difficult to measure digitally. It used to be done by loan officers, right? Your loan officers used to be the guys telling you, or the ladies telling you, if you trusted this person to be, someone that was ambitious, a perfectionist that really was going to move forward. And so I think that's a bit new for a lot of credit bureaus. And so that's still quite a new concept. So this idea that we can be used on top of it, I think is a bit of an interesting segue into it, and hopefully is something that a lot more banks will realize. To really get the edge in this market, you need to be able to score everyone and to get a full profile of them. And so I do think that we add, on top of being this first kind of option for credit score, we add a lot throughout the journey of the customer.
And would you say that psychometric is sort of a growing category relative to zero balance airtime type, where you're basically getting information from the phones? Is that, have you seen a lot of sort of evolution in that space of psychometric?
Yeah, so, obviously it's all depends on your customers, right? And obviously it depends on the competition. So if you have a situation where, you are the only one asking someone to do a 15-minute test and your competitors are getting data within a minute, well, it's tricky to ask for a psychometric test on top. But again, not everyone is there. There's still a lot of people that don't have smartphones. There's still a lot of people that are, that don't have data, don't have connectivity. And so then psychometric works really well for these people. Or even, so let's say SMEs that are taking larger loans. So in that case, they're willing to take a bit more time to fill out a questionnaire. And so, yeah, you're collecting very different data. So I think it's, I would say it goes hand in hand. It's like they're both very predictive. Even Android phone data, they're all very predictive. It's just, it depends what is your reality, what is your customer journey, and what you find more important for your customer. Quickness versus kind of new data points versus enabling to score everyone, because that is the beauty of psychometrics, right? So it all depends what is your priority.
Understood. Makes a lot of sense. Mahesh, turning to you, there are various fintechs out there that are sort of positioning themselves as the sort of the expert specialists, sort of having tech that's ultimative and unique in resolving the chaos of payment schemes. And you're working for an august bank, an institution that's been around, and I forget how long, but I want to say over 100 years. I became familiar with it.
Many markets, yes.
Yeah, in Africa. So you are at the heart of banking. And for those who are sort of listening in on this webinar and watching in and wondering, where is the difference, and sort of like, how does one even think about, how do you frame this issue of like, here's a bank that has been doing banking sort of like the traditional way for over 100 years on the one hand, and then you have all these Silicon Valley and equivalents across the world startups that say, oh, forget the banks, we are coming in here and we're going to sort of clean up shop, and we are the key to payments in the new economy. How do you reconcile the messaging coming out of those kind of businesses and the kind of investor world activity, and those who gravitate naturally and understand the solidity and the sort of comfort of traditional brick and mortar banking institutions and banking models? Where do the two meet, and how are they different?
Sure. So the way we look at it, Judah, is initially, yes, when there was this whole fintech boom, I think banks saw fintechs as threats and vice versa, right? And that's where this whole perception of banks feeling fintechs are out to grab their lunch, right? But I think over time that has changed, right? And that's actually true for e-commerce as well. In a way, if you see, when a lot of the e-commerce players saw the brick and mortar setups as a threat and vice versa, right? But I think what has happened interestingly over the last few years is they've all realized that they need to coexist, right? It's not about one or the other, because and it's a very interesting situation, because as you rightly mentioned, some of these well-funded Silicon Valley, whether it's fintech or a startup, have some of the best technology, also in terms of the UX and some of the best technical brains in the industry. Having said that, what they perhaps lack are some of these relationships with these large institutions, right? Which is where I believe, as a bank that's been around for all these years, supporting organizations, run their businesses in these markets. We believe we bring that value, right? So we see this as a great opportunity for collaboration, and that's where, as a bank, we believe it's a great time because uh, you know for both banks and fintechs to get together, work closely, and help solve these challenges for organizations in a manner that benefits both, right? The fintechs, the banks, and also in the process our respective client base. And that's where we believe, having handled the financial flows for some of these organizations over the years, uh, being their cash management bank, whether it is on the payment side or on the collection side, uh, we have a fairly robust understanding of the business model of these organizations, and that gives us some great insights around how we can marry some of these new age tools and technologies to solve some of the old world problems, right? And that's where we value the vintage that we have had in this space, despite at times not having the nimbleness of a fintech. And that's also set to change in a great way because uh, you know as I don't know if you know, so we do have our own fintech arm called SC Ventures, which actually invests in fintechs and drives innovation, right? By collaborating uh, with these players actively, and again, throwing some of these real world challenges out there, and finding fintechs who can come up with solutions to solve for those. So in a way, getting both the communities to meet, right? The external community of fintechs with the internal community that is trying to solve for some of these real world challenges with these for these organizations. So I see this opportunity for collaboration only increasing in the years to come. Both banks, banks need fintechs as much as fintechs need banks. And both can work together to co-create some great solutions for our mutual client base.
Excellent. Very interesting. Yeah, I think the many businesses, we've got to know this whole space by needing a merchant account back in the day, and the definition of needing a merchant account has evolved quite dramatically over the years. But that still kernel of needing a merchant account doesn't go away. So it leaves a lot of room to build the innovation and co-create, as you said, on top of it. Camille, it's an unavoidable topic, and not in a negative way, but really in a responsible and even forward-looking way, to bring up COVID-19 and the pandemic in a discussion like this, and thinking about what the future portends, and whether some of the dramatic catalyzing we've seen in digitization in the past year, by dint of lack of choice and not sort of the natural curve of development, how that will hold and change perhaps in the years ahead. So I want to first ask you, have you seen anything sort of from your experience across the different markets where Lendo EFL is active? Have you seen any patterns in sort of scoring and repayment sort of emerge in the past several months that are noteworthy? And is there any impact even in how you conduct your evaluations and sort of support your partners as they try and work through the uncertainties of the current period, and as they try and scale in a context which really has as many questions as it does have certainties? The only certainty is that there's this need for even even swifter evolution and swifter change and swifter scaling. So I'm both interested in terms of what you've observed on the one hand, and also if and how you're pivoting in order to assist your partners pivot and attack and adjust to a future which has, as many unknowns as it does have knowns.
Yeah, no, definitely. So I would say, just in general, we've seen definitely, a significant increase in demand and, a willingness to sort of understand alternative data and how it can affect, the credit risk, because obviously a lot of people are now defaulting. There's obviously a lot of issues, all over the world in terms of payments, and how borrowers are able to pay back their loans. So that's, I think, is quite an interesting perspective. A lot of people realize, our score, is actually not correlated in the same way to economic conditions, whereas a credit bureau score in a way is very much correlated to it, right? So if there's an economic condition that's negative, everyone will start defaulting, and that will impact their score. Versus our score, I would say, is a bit more stable. And actually, interestingly enough, we've published a recent article with one of our clients in Nigeria, and that's exactly what we saw. So we saw that our score was surprisingly resilient, right, through the lockdown and kind of economic uncertainty that happened with COVID. And we kind of potentially didn't, we didn't really know. It was a really, despite obviously the situation, it was an interesting learning to see how stable our score was. And so that's because I suppose our score is based on key character traits that do not change, right? The same way as your financial situation will. And so we've seen, actually, yeah, it was a very, very interesting insight. And so basically our client, for instance, in Nigeria was able to lend and continue lending, and increase lending throughout the crisis when people were in most need, because the models were still working very well. And so we actually haven't updated them, in all this time. And we've seen something very similar with that same Asian bank, where we compared results after COVID. And similarly, our models were more resilient, and as a result of the fact that we are not so basically relying on things that change, such as your financial situation. So yeah, that was, I would say that's probably a really quite an interesting insight from COVID for us. Yeah.
Thank you. Yeah, that is very interesting. That character sustains itself. Character traits sustain themselves despite hardship.
It's quite logical.
Yeah, it's interesting.
Yeah. It's more long-lived. It's more who you are versus what you're going through right now.
So do you see that being something, a key learning into the future economy? You think that's something that people will count on more as they try and transact with individuals and businesses?
Well, it would make sense, right? It would make sense, especially when, obviously, this is, kind of a very unexpected event. But, it just makes, I think it should make everyone think that having a different perspective on someone and not just relying on their finances, which seems to be something that's, should be quite representative of someone. But again, when there's something like this, where you're not really in control of a lot of it, actually looking at another side of your personality, another side of, another profile of your risk is really helpful. And so, no, I hope that will be a big learning from this. Yeah.
Absolutely. Mahesh, I want to slightly pivot, but very, very lightly, if you'll permit me. We're focused on payments and the API and the ability to really almost extend, open up our arms in such a way that can allow for sort of traditional payment to faster payment to real-time payments, and also for a bevy of different types of payment solutions, from from pseudo offline enablement to become digitized to the most digital and the traditional credit and so forth. You know, billing is a topic that's fairly close to this, and you have an emergence of many players, including in the banking space, that are trying to extend the sort of the simplification and integration of payments that you're focused on, to being able to do the same for those who would, on the one hand, try and accommodate um, um, billing to many, many different types of entities and many different types of mechanisms, and on the other hand, acceptance, right? Which again sort of relates to payment. So to facilitate sort of this whole billing universe on behalf of the customers, the would-be corporates and even the SMEs that are struggling with this space. Does how do you see that sort of conundrum, and how does it relate, really, how does it interact with some of the payments innovations that you're describing and are focused on? Are they sort of hand in hand, really, two sides of the same coin, or are there certain complexities and issues to resolve on the billing side that may not be appreciated when, purely from the payment side?
Yeah. No, you're right. I think the way I see it is, they go hand in hand, in the sense, uh, traditionally, again, billing has been a space that's warranted uh, a lot of efficiencies, right? While there have been solutions around electronic invoice presentment and payment, etc. Uh, they have been popular, I believe, in the West, again, markets like Europe to some extent. But when you come to markets like Asia, Africa, etc., the levels of adoption have not been the same, and that's where we are seeing that shifting gradually, where as organizations are trying to drive digitization across the organization, the whole invoicing piece is, again, that's being looked at very closely. And organizations increasingly are looking at ways and means of integrating that into the workflow. And that's where, as much as you would look at digitizing the presentment of the invoice, again, the solution is not complete till you digitize the payment leg. And that's where I see definitely a lot of synergies between the billing aspect and the payment aspect, right? And to that extent, again, I do see many players emerging in that space, providing solutions that can give organizations that out of the box capability to plug into their platforms, and digitize the presentment of invoices to their end consumers, whether they're individuals or businesses. And these platforms plugging into payment gateways to present those multitude of payment options to the end consumer, right? So that's where, at the end of the day, I would say, the 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 richness of that billing platform is also going to be greatly defined by the capabilities that it can bring in terms of the flexibility and the variety of payment options, both in terms of the traditional payment methods such as cards, and some of the local payment methods that are emerging quite rapidly in these ecosystems.
Excellent. Yeah, that makes a lot of sense. Well, this has been a fascinating and insightful discussion. I want to give you each an opportunity to perhaps offer final thoughts before we wrap things up. So, Camille, please.
Yeah, no, this was really, really, really interesting, and obviously, yeah, I just hope that you know the options alternative credit scoring offers are clear, and I hope that that is you know something that a lot of lenders can think about. I do also like the idea that you know all this partnership. I think this idea that you know fintechs and banks, you know, are very much, you know, like should partner together. You know, banks, as we all know, like know what to focus on, their core, you know, sort of their core knowledge and what they, you know, which is serving the customer. But then obviously using third party for these kind of things, I think makes a lot of sense. And hopefully that is, you know, how people can think about us as a sort of, you know, a new way to think of how to lend to a lot of customers that are currently kind of losing. So a huge opportunity cost that we can help, you know, solve for them. So yeah, that's I think my closing remarks.
Absolutely. Thank you. No, thank you very much for that. And it's all about expanding the partnerships and expanding the market in that way. And Mahesh, what are your thoughts in closing?
Sure, sure. Yes, it's been a great discussion. I think you know the pandemic, while it has done you know a lot of damage on many fronts, but I think it's also you know brought a lot of great things to the fore in terms of the sheer number of possibilities for organizations to embrace digitization and drive efficiencies in their business model. So I see you know these trends around organizations leapfrogging into e-commerce, m-commerce, whether it is through you know in the form of a b2c platform or a b2b platform, here to stay. And it's critical that organizations, irrespective of your size or stature, actively look at these developments and see how you can invest and embrace these to you know stay competitive in the marketplace, and at the same time enhance the customer experience. And that's where I believe both banks and fintechs can make a difference to organizations in that journey. And collaboration is going to be a key to that success story, and something that will end up being a win-win for all the stakeholders in the value chain.
Thank you for that. Yeah, I guess complacency is not an option, right? We can pay witness to all of these developments around us, but it's not enough just to observe. We have to somehow have a position, and we have to participate. And if we can find a way to work together in order to evolve our businesses and prepare for what is a future that is going to look different from the present, that we know for sure, then partnership and sort of embracing the digital and the scale is the way to go. So I thank you very much for that, for what's been a fascinating discussion. And we, of course, welcome all questions from those who are watching and taking in the webinar. And on behalf of MEF and Mondato, I just want to thank our wonderful speakers and all those who have participated in this session for what has been a really insightful discussion. So thank you very much, and wishing all a very pleasant rest of the day.
Thank you, Judah. Pleasure talking to you.
Thank you very much.